I want to begin by challenging a good intention that almost everyone in this room has been taught to admire. The idea that if government just steps in a little more, regulates a little tighter, redistributes a little further, and plans a little smarter, prosperity will become fair, stable, and permanent. It sounds compassionate. It sounds reasonable. And yet, over and over again, it quietly does the opposite of what it promises. It slows innovation, it punishes risk-taking, and it transfers power away from individuals and towards systems that cannot possibly see the future as clearly as the market does. I have spent my career studying innovation not as a buzzword, but as a force of nature. Innovation does not move in straight lines. It does not ask for permission. It does not arrive politely. It explodes. It compounds. It surprises. And it humbles the experts who insist they can forecast it using yesterday's data. And if there is one thing I have learned as an investor, as a founder, and as a steward of capital, it is this: freedom is not just a moral principle. It is an economic accelerator. I want you to hold that thought because by the end of this conversation, I will share a truth about freedom that many people sense intuitively, but very few are willing to say out loud, especially in finance. Now let me take you somewhere deceptively simple. Think about the device in your pocket. A smartphone. No single government ministry designed it. No central planner coordinated the millions of decisions required to make it exist. It emerged from a vast decentralized network of entrepreneurs, engineers, investors, failures, pivots, and risk-takers, each responding to signals, incentives, and opportunities. Prices, profits, losses, information, that is the market. And the market is not chaos. It is order without command. For decades, investors have been trained to look backward, to extrapolate trends, to worship size, to assume that the largest companies today will necessarily dominate tomorrow. Amazon is often used as the ultimate example. Massive scale, unmatched logistics, extraordinary execution, a company that redefined commerce, cloud computing, and consumer expectations. I respect that achievement deeply, but respect for what has been built should never turn into blindness about what is coming next. The biggest investing mistake I see, again and again, is confusing incumbency with inevitability. History is ruthless on this point. The dominant companies of one era almost never remain dominant through the next technological paradigm, not because they are stupid, not because they are lazy, but because success creates gravity, and gravity resists radical change. Innovation, especially truly disruptive innovation, does not politely integrate itself into existing business models. It attacks them. It undercuts margins. It rewrites cost structures. It shifts value creation away from centralized platforms and toward new architectures. At ARK Invest, we focus relentlessly on what we call disruptive innovation platforms, artificial intelligence, robotics, energy storage, blockchain technology, multi-omic sequencing. These are not incremental improvements. They are general-purpose technologies, and general-purpose technologies do not add a few percentage points of growth. They rearrange entire economies. Now let me address the title directly, because I know it provokes a reaction. The idea that a single investment could outperform Amazon over the next decade sounds almost heretical to traditional finance. Amazon has become a symbol not just of success, but of permanence. As if scale itself were a moat against the future. It is not. The next decade will not be defined by who owns the most warehouses or who can ship a package the fastest. It will be defined by who owns intelligence, by who controls autonomous decision-making systems, by who can train models that learn, adapt, and improve at a speed no human organization can match. Artificial intelligence is not a feature. It is an operating system for the global economy. And when you understand that, you begin to see that the most valuable companies of the next era will not look like the giants of the last one. Let me be very clear. I am not talking about AI as a tool layered on top of existing businesses. I am talking about AI native companies. companies whose core economics improve as intelligence scales, companies where marginal costs approach zero while value creation accelerates. This is where freedom enters the picture in a way most people miss. The greatest breakthroughs in AI are not coming from centralized bureaucracies. They are coming from open competition, from small teams, from founders willing to challenge orthodoxy, from capital markets that reward long-term vision rather than quarterly comfort. When regulation tries to freeze this process, when policy tries to decide in advance which technologies are safe, acceptable, or fair, it does not protect society. It protects the status quo, it locks in existing power structures, and it delays the very productivity gains that could lift living standards for billions of people. Now think about Amazon again. Its genius was logistics, scale, and platform efficiency in a world where commerce was physical and coordination was expensive. But AI changes the economics of coordination itself. When software can reason, predict, and act autonomously, the advantage shifts away from centralized control and toward adaptive intelligence. The investment that I believe will outperform Amazon over the next decade is not defined by retail. It is defined by computation, by data, by learning curves so steep they look impossible on traditional charts. This is where many people get uncomfortable, because they sense what this implies. If intelligence becomes abundant, if decision-making becomes automated, if productivity explodes, then many of the assumptions we hold about labor, income, and equality begin to crack. And this is where governments often rush in with good intentions and disastrous consequences. They try to slow the change, to tax the future before it arrives, to regulate innovation as if it were a stable, predictable process rather than an evolutionary one. In doing so, they risk suffocating the very engines of growth that could solve the problems they claim to care about. Freedom, in this context, is not about ideology. It is about feedback loops. Free markets generate information. They tell us what works and what does not. They allocate capital toward better solutions. They punish inefficiency without requiring a committee meeting. The companies that will define the next decade will be those that operate inside these feedback loops at machine speed. Artificial intelligence companies that own foundational models. Robotics firms that integrate perception, cognition, and action. Energy storage innovators that collapse the cost curve of power. Blockchain networks that replace trust in institutions with trust in math. These systems scale differently. They do not need permission to grow globally. They do not depend on physical expansion in the same way. And most importantly, they are anti-fragile. They improve under stress. Amazon, for all its brilliance, is still deeply tied to physical infrastructure, to labor markets, to regulatory regimes that vary by country and are increasingly politicized. That does not make it weak, but it does make it constrained. The next dominant platforms will be constrained primarily by imagination and compute, not by trucks and warehouses. Now, I want to slow down here because this is where the conversation often becomes emotional. People worry about jobs, about displacement, about inequality. These concerns are real, but they are often framed incorrectly. Technology does not destroy work. It destroys specific tasks. And in doing so, it frees human creativity to move up the value chain. Every major technological revolution has followed this pattern. The printing press, electricity, the internet. Each time there were fears of mass unemployment and social collapse. Each time productivity surged, new industries emerged, and living standards rose. The difference today is speed, and speed makes people anxious. But anxiety is not an investment thesis. If you look at the data, you see something extraordinary forming. The cost of intelligence is collapsing. The cost of energy is collapsing. The cost of computation is collapsing. When three foundational inputs to economic activity become dramatically cheaper at the same time, growth does not just increase, it changes character. We are moving from a world of scarcity management to a world of abundance creation. And abundance is deeply threatening to centralized power. That is why debates about AI are so often framed in terms of control rather than opportunity. Who gets to decide? Who gets to regulate? Who gets to own the future? As an investor, I ask a simpler question. Which systems align incentives with human progress? Which architectures reward truth, efficiency, and innovation rather than compliance and rent-seeking? The answer points consistently toward decentralized AI-driven platforms. Now let me return to the promise I made at the beginning, the subtle hint that there is a truth about freedom that many people avoid. Here it is, stated plainly. Freedom is not fair in the short term, and it is precisely because of that it is fair in the long term. Freedom allows inequality of outcomes because it allows inequality of ideas, effort, timing, and risk. When we try to suppress those differences, we do not create justice. We create stagnation. We flatten the peaks that pull the entire landscape upward. The investment that will outperform Amazon over the next decade will do so not because it is protected, subsidized, or anointed by policymakers, but because it is allowed to compete, to fail, to learn, and to scale without asking permission. That is the power of freedom in markets. And as I look forward, as I watch capital flow, talent migrate, and innovation accelerate, I see a future where the greatest value creation comes from those who embrace uncertainty rather than fear it, who trust decentralized intelligence rather than centralized authority, and who understand that the most dangerous phrase in investing is not "this is risky," but "this time is different because the incumbent is too big to fail." Because right now, right at this moment, the forces that once made Amazon unstoppable are being challenged by something even more powerful, something that does not ship boxes, does not sleep, does not unionize, does not lobby, and does not wait for approval, something that learns, adapts, and compounds in silence. And the question investors must answer is not whether this force will reshape the economy, but whether they are willing to recognize it before it becomes obvious to everyone else. And by then, priced in. Priced in, because once something becomes obvious, the extraordinary returns are already gone. Markets reward anticipation, not confirmation. They reward the willingness to look foolish early rather than the comfort of being right late. Now, let me take you deeper into what this actually means in practice, because abstraction is easy and conviction is earned in specifics. When intelligence becomes a commodity, when machines can reason, predict, and act at marginal costs approaching zero, the center of economic gravity shifts. Value no longer concentrates where labor is cheapest or where logistics are most efficient. It concentrates where learning is fastest, where feedback loops are shortest, where systems improve themselves without human intervention. This is why the next dominant investment is not simply a company, but an intelligence engine. Traditional firms grow by adding inputs, more people, more capital, more physical assets. AI-native firms grow by improving algorithms, by training models, by absorbing data. Their output scales non-linearly. 10 times more compute does not give you 10 times more value. It can give you 100 times more insight. That is not a normal business dynamic. That is a phase shift. And this is where Amazon's past success can quietly become a future limitation. Amazon mastered optimization in a world governed by human constraints. But AI is rewriting the constraints themselves. Decision-making no longer needs layers. Forecasting no longer depends on historical averages. Logistics no longer requires centralized orchestration when autonomous systems can coordinate themselves. The winners of the next decade will not merely use AI, they will be built around it. Their balance sheets will look strange to traditional analysts. Fewer tangible assets, more intellectual capital, less linear growth, more volatility early, followed by explosive dominance. This volatility scares people, and fear drives regulation. We are already seeing calls to slow AI development, to license intelligence, to gate innovation behind political approval. These proposals are always framed as protection of jobs, protection of democracy, protection of safety. But protection from what exactly? From competition, from decentralization, from individuals having more power than institutions. Freedom is dangerous only to those who benefit from control. And this is why the debate around technology is never really about technology. It is about power. Who decides? Who benefits? Who bears the risk? In free markets, risk is borne voluntarily. Capital flows toward ideas because investors choose to believe in them. Failure is painful, but it is localized. Success is rewarded, but it is earned. In managed systems, risk is socialized. Losses are spread. Incentives are distorted. Innovation slows. And eventually, everyone pays through stagnation. As an investor, I am not interested in systems that promise stability by suppressing change. I am interested in systems that generate progress by embracing it. Now, let me address the emotional core of this conversation because it matters. People hear that an investment could surpass Amazon, and they hear disruption, and they hear threat. They imagine a world where machines replace humans, where wealth concentrates, where the future feels alien. But that fear misunderstands both history and human nature. Humans are not valuable because we can process information faster than machines. We are valuable because we can imagine, create, empathize, and assign meaning. When machines take over routine decision-making, humans are freed to operate where they are uniquely powerful. The tragedy is not that technology advances too quickly. The tragedy is that our institutions adapt too slowly. Education systems still train people for tasks rather than thinking. Regulations still assume static industries rather than dynamic ecosystems. Fiscal policy still treats productivity gains as threats rather than gifts. This mismatch creates tension, and that tension is often misdiagnosed as a failure of markets rather than a failure of imagination. The investment opportunity I am pointing toward exists precisely because of this mismatch, because markets, unlike institutions, adapt. Capital seeks efficiency. Talent seeks opportunity. Innovation finds paths around obstacles. No decree has ever stopped a superior technology from spreading. It may delay it. It may raise the cost, but it cannot reverse it. This is why attempts to freeze economic hierarchies always fail. They underestimate the power of decentralized problem solving. Now, let me say something that may sound uncomfortable, but it is essential. Equality of outcome is incompatible with exponential innovation. When returns scale nonlinearly, when ideas compound faster than labor, disparities will emerge. Trying to eliminate those disparities by force does not create fairness. It destroys the incentive structures that make progress possible. True fairness lies in equality before the rules, not equality after the results. Freedom ensures that anyone can participate, but it does not guarantee that everyone will win equally. And that is not a flaw, that is the engine. The companies that will dominate the next decade will do so because they create outsized value, not because they extract it. They will make entire systems more efficient, more accessible, more affordable. Think about what happens when intelligence becomes cheap. Medical diagnosis improves. Energy systems optimize. Transportation becomes safer. Supply chains self-correct. Entire categories of waste disappear. That is deflationary, deeply deflationary. And deflation, when driven by productivity, is not a curse. It is a blessing. It means more with less. Higher living standards. Greater choice. Yet deflation terrifies policymakers because it reduces their leverage. It exposes inefficiency. It punishes debt-fueled systems. This is why so many economic debates feel upside down. Why abundance is treated as danger. Why innovation is treated as disruption rather than progress. As investors, we must see through that inversion. Now, let me bring this back to the core claim, because by now, you can probably sense where this is going. The investment that will outperform Amazon over the next decade is one that sits at the intersection of artificial intelligence, autonomy, and scalability. A platform that does not merely sell products, but creates intelligence that others build upon. a system that improves itself as it grows, a company whose addressable market expands faster than any logistics network ever could. This is not a prediction based on hope, it is a deduction based on economics. When the marginal cost of intelligence approaches zero, the demand for intelligence approaches infinity. Everything becomes a software problem, and software eats the world not because it is clever, but because it is efficient. Amazon was software-enabled logistics. The next giant will be logistics-enabled intelligence, or perhaps no logistics at all. And this is why I remain so optimistic, not just about returns, but about humanity. Freedom-driven innovation does not lead to dystopia. It leads to adaptation, to reinvention, to new roles we cannot yet name. The danger lies not in moving too fast, but in trying to slow down what cannot be stopped. Now let me deliver the truth I promised, clearly and without hedging. The most fundamental truth about freedom is this: freedom requires trust in the unknown. You cannot plan your way into a better future. You must allow it to emerge. Markets are not perfect. People make mistakes. Capital is misallocated. Bubbles form. Corrections hurt. But through that messy process, progress happens. The alternative is far worse. A world where outcomes are engineered, innovation is rationed, and permission replaces possibility. That world does not protect people. It imprisons them in yesterday's assumptions. As investors, as thinkers, as citizens, we have a choice. We can cling to the comfort of incumbents, or we can engage with the forces reshaping reality. We can demand certainty, or we can cultivate understanding. The investment that will surpass Amazon is already revealing itself to those willing to look beyond scale and toward structure, beyond size and toward adaptability, beyond power and toward intelligence. And the final invitation I offer you is not to buy anything blindly, not to follow slogans, but to think deeply, to read, to question, to challenge narratives that promise safety at the cost of growth. Because the future does not belong to those who ask for permission. It belongs to those who understand that freedom, however uncomfortable, is the only environment in which extraordinary progress can occur. And as I look forward, as I watch capital flow, talent migrate, and innovation accelerate, I see a future where the greatest value creation comes from those who embrace uncertainty rather than fear it, who trust decentralized intelligence rather than centralized authority, and who understand that the most dangerous phrase in investing is not "this is risky," but "this time is different because the incumbent is too big to fail." Because right now, right at this moment, the forces that once made Amazon unstoppable are being challenged by something even more powerful, something that does not ship boxes, does not sleep, does not unionize, does not lobby, and does not wait for approval, something that learns, adapts, and compounds in silence. And the question investors must answer is not whether this force will reshape the economy, but whether they are willing to recognize it before it becomes obvious to everyone else, and by then, priced in.